February, new month. We couldn't get rid of January fast enough, in my opinion. So here we are in February, and you're wondering, what stock should I buy now? I'm going to bring you a whole bunch of ideas today. I'm going to give you a variety, large cap, small cap, growth, DGI. I'm going to give you a balance, something for everybody on this one, guys. You're going to want to see it, so let's get going. So one of the subcategories today, guys, is going to be beaten down growth stocks 50% or more. And I'm going to start with one of those. This is going to be Square. It's now Block Inc. It used to be called Square, now it's Block Inc. Essentially, this one, guys, has been beaten down over 50%. It was a $289 stock, now trading at $122. The low actually was $101.75. And I want to make sure I explain this. When I'm covering this video, it's very difficult to time bottoms. So for me, this is long-term investing, dollar cost averaging, trying to find the best opportunity and buying it really at levels. So if you really like this stock, maybe you nibble in this range. It just ran 10% yesterday, so you have to be careful with that. But you'll probably buy in lots. So you might buy, 4 or 5, maybe 6 lots, up to you, and really try to back your way into a good cost basis on a stock like this. Of course, $101 and $122, it's already bounced 20% from the low point. And there's a lot of stocks like this, a lot of growth stocks have popped. What could happen, guys, is you could see more volatility throughout the year. There's a lot of things that could happen. The Fed could come out tomorrow and raise rates 50 basis points instead of 25, and you're going to see gyrations in the market. You're going to see some of your favorite stocks go on sale. So you've got to it's a tough environment. These are really difficult situations. I've been investing almost 25 years, and I've been through a lot of these, and I can tell you, you're never going to time it perfectly, so just do your best. Try to buy, like I said, in lots. I use technical analysis, try to get better entry and exit points. The thing is when technicals are this beaten down and this broken on some of these names, it's really impossible to know where it could go. And oftentimes it goes lower than you think it's really going to go. So Square's the first one. It is still trading at 114 P ratio. I do like this one a lot. They actually announced yesterday that they have the ability now to use Afterpay, buy now, pay later. So they're starting to integrate that into the business model. And you think of buy now, pay later, that's been a huge kind of mega trend or tailwind. And I think that will be something that will help the business. I also like the cryptocurrency part of Block Inc. I think they can do a lot of things with cryptocurrency as well. So this is a stock that I would be holding for long term. When you think of like a reopen trade too, guys, a lot of restaurants and bars and whatnot use Square, to take their transactions, their payment system. Of course, you've got other ones that compete in that area as well. But Square really does have a lot of great business segments. It's not a one-trick pony by any means. You think of Cash App kind of competing with PayPal's Venmo. You've got the crypto. You've got the point of sale. There's a lot of great things going on. And they're, of course, now trying to get more into the crypto and blockchain side of the business as well. So I think this will be an exciting company. It'll probably be a metaverse play as well. And I think if you can back your way into position, thinking very long-term, 5-10-year type investment, this one is attractive at this level, especially if you can get it even lower than here. The next one, Google. I prefer the A shares. That's GOOGL. You can also buy the C shares. It's GOOG. There's really not much difference. It has to do with voting. It probably doesn't matter if you're not buying a ton of shares. Now, this one is about a 26P ratio. I think it's growth at a reasonable price. It's just under $1 trillion market cap. The all-time high on this was $3,019, so it has not been beat down like a lot of the names. This is going to be one of those tier 1 type names, more high quality, more in the fashion show, more stable, has cash flow, has a P ratio and whatnot. So Square, I'm thinking more of the hyper growth, beat down 50% or more. This is more of your tier 1 type of a stock. Alphabet, I think this is a good one long term. It is up 48% in the 52 week. You can see it's made a nice little pullback. The recent low here on this sell-off was just above $2,500 a share, so it's held in there pretty well. It is still reasonably priced here at this 26P ratio at $2,700. It's one that if you don't own, it'd be a nice tier 1 to add to the portfolio and try to get a good cost basis, dollar cost average into the stock. Now, I've been bullish on this one for a while. It was a SPAC, so beware. I say that all SPACs are spec. You got to put it in your spec bucket. But this is SoFi, and it has come off the lows pretty nicely. It was down to $10.51, so it has bounced significantly. But I think it has a lot of room to go, and I think this is a great type spec play in your portfolio. It's a $10 billion market cap. This is the home. SoFi Stadium is the home of the Rams, which of course is where the Super Bowl is. It's going to get a lot of exposure from that. It's of course not the reason to buy the stock, but it does help with just the name recognition and the brand awareness. Now these guys, if you haven't heard, they did acquire Golden Pacific Bank Corp, and they've got now a bank charter. And what that's going to do is it's going to cut interest expenses. It's going to get rid of the middleman. It's going to make basically better prices for the customers and higher margins for SoFi. And I've seen estimates anywhere from 200 million to 300 million. So that's pretty impactful on a $10 billion market cap type stock. Now, this company is not profitable. So of course it's not in the fashion show right now. That's why I would put it in my spec bucket. But I think it's one of those, if you can accumulate shares, especially at $10 and $12, I think long-term you'll be very happy with this investment. Curveballs, I like curveballs. A little bit of a curveball here. This is one from the Discord community. Definitely join us. It's a new month. It'd be a great time to check it out. You saw in the intro, that was Discord. That's where our community meets up and talks about stocks every single day. The elite channels basically give you access to the top stuff, including my portfolio, my buys and sells and things like that. Now, Latch was brought up. It was researched in the Discord community. One of our members named Alfred, I'm not sure if he owns a stock or not, but this was, I believe, an IPO last year. It's actually a $911 million micro cap, so very, very small cap. So there's some risk with that. But here's the thing. This was $18.24, the highs on February 3rd, 2021. And it sold down on January 28th, just a few days ago, down to $5.43. So this thing literally has been absolutely hammered. It's trading right now at 641. It did bounce nicely off that 543 low. This is one I would put in my spec bucket, but I'm telling you, there's a lot of opportunity with this company. Hey guys, quick intermission. If this video is helpful, drop me a like and drop me a comment. It helps support the channel so I can keep making videos. If you're new to the channel, definitely subscribe. Click that bell to get notifications. Back to your scheduled content, especially at this price. Now I've got some notes here. So this is a smart building technology. Its portfolio includes a range of hardware, software, and services. So it does have some SaaS in it as well as hardware. Its core product is Latch OS, a full building operating system that powers a range of devices, including door-mounted access controls, intercoms, and cameras. So Latch makes it possible to unlock doors with smartphones, grant visitor access. Realtors use this quite often. There's a lot of great things going on with this company. Recent quarter revenue came in at 11.2 million. So you could argue this is maybe still expensive for the valuation, but it's certainly something to at least keep on your radar. It was once $18 stock. It doesn't mean it's going to go back to that price, but this is a real company making real products. And it could be one of those speculative assets that if you buy at the right price and accumulate shares, it could be worth a lot more down the road. Nvidia, guys, I've been bullish on this for a long time. I've been long on the stock since 2018. I'm up over 500%. I did cover this back in 2021 before the split, said it was a buy. It was below $200. It ran all the way to almost $350, and it actually has pulled back significantly. It got down to around $220 in that range, something like that. It's trading right now at about $250. So this is a 75P ratio. It does pay a very small dividend. It's almost meaningless, but 0.07%. It's still up 88.5% on the 52-week. I like this as a very long-term growth play in the portfolio. I consider it a tier 1 stock towards the end because of valuation, so it's closer to tier 2 simply because of the valuation. Some people could argue 75 PE is too expensive, but if you look at the growth prospects and what this company has going for it, many people would put it very high on their list. In fact, we did a poll within our Discord community and talking about what stocks to buy now at these levels, and Nvidia was the #1 pick out of our community, and it was by a huge margin. Actually, it was by several votes. So Nvidia, still like this one. Of course, the cheaper you can get it, the better. It's hard to really guess a bottom, but it does look like it found a little bit of a base around that $220 range. Anything, if it ever gets to 200 or less, in my opinion, it's a must buy for any portfolio. And this stock really, regardless of your risk tolerance, age, in my opinion, Nvidia should be part of every single portfolio. This is one of my favorite stocks, and I think it's going to go much higher over time. Now, a good segue to this, Meta Platforms used to be called Facebook, ticker is still FB. They are using Nvidia GPUs to build this massive supercomputer for the metaverse. Okay, so this is a metaverse play. Another growth at a reasonable price are GARP type stocks, same as Google. Facebook, 22.36P ratio. This is not one I own in my portfolio. I do own most of these other stocks in my portfolio except for a couple, but Meta Platforms is one. If you can get this thing below $300, in my opinion, as a long-term investment, I think it's a good one to have in the portfolio. There's always risk with Department of Justice, with antitrust, things like that, because of privacy issues and whatnot. So that's always going to be lingering in the balance. And I think that's part of the reason the stock doesn't perform better than it does. Right now, it's about an $870 billion market cap. If this thing gets below $300, in my opinion, it's an opportunity to add to a long-term investing portfolio. So this might seem like a curveball to you as well, but if you've followed me for a while, you know that I do have blue chips in the portfolio. I've got what's called a barbell portfolio, and I highly recommend those. You know, building a portfolio that has hyper growth in it, but also has blue chips, has stability, and has diversity. Diversification is very important, and it helps you get through these ups and downs and kind of ride these storms out. So Bank of America, I've had this since 2016. My camera was gone there. All banks really trade at a low PE ratio. So this one's a 13 PE ratio, but keep in mind, all banks generally trade at lower valuations. This one does have interest rate sensitivity. So as interest rates rise, it really does impact their bottom line. It's trading around $46. The all-time high on this was about $50. This is not in a portfolio to give you hyper growth. It gives you a nice little dividend, 1.82% dividend. It's really more of a kind of a hedge almost towards interest rates. If interest rates go higher, this is the type of stock that will benefit. It gives you a little balance, a little bit of that barbell in your portfolio. Check out Bank of America, ticker BAC. So Amazon, I recently said, $27.50. That's where I'd be buying this thing. It did get down to $27.07. Of course, I made a video earlier in the year and I liked it anywhere around $3,000. I honestly didn't think it would get less than $3,000, but when the whole market sells off and all the technicals break, it makes sense. It was an opportunity in my opinion. Right now at $3,000 a share, I still think this is an opportunity, especially if it dips back and retests. 58 P ratio, which you could argue is expensive, but these guys have so much going on for them. It's one of my top holdings. So Nvidia and Amazon are both each about 5% of my portfolio. And this one is one that kind of popped from the pandemic. It ran really hard and it's been trading literally sideways to lower for the last, 18 months. I think it's eventually going to break out of the range. I think the back half of 2022 is favorable for Amazon. And you think of all the things they have going for them. They've really spent a lot of money on capital building out their facilities, and they're going to benefit from that longer term. They're going to start doing more drone deliveries, on and on and on. You think of Amazon Prime, you got all those memberships, all that recurring revenue. AWS or Amazon Web Services, they are the leader in cloud services. That's the main reason I really like Amazon, but there's so much more to Amazon, especially when you think it down 5-10 years. This is a behemoth. It's positioned well. People worry about antitrust and breaking them up. If you broke this business up into different segments, it would probably be worth more than it is now at $3,000 a share. In fact, some people argue that Amazon Web Services alone could be something like $2,000 a share. I'm not saying that I agree with that necessarily true or false. I'm just telling you what some analysts and some people project if a company like Amazon were to be broke up. So this is a $1.5 trillion market cap. It's not going to give you hyper growth. It's one of those I consider tier one, even though it is a 58 P ratio. I think this is one you add into a portfolio. You add these type of levels as an opportunity, and over time, I think you'll be very happy with the results with Amazon. So Amazon is the next pick on the list. Now, of course, there's a lot of people talking about recession, and if there's a recession, consumer staples do very well because people are still going to buy the food they need, the household items they need to live and survive. Now, this is not a cheap stock. It's not necessarily one that you just go buy hand over fist. It's trading at a 29 P ratio. It does always get quite a premium because it does pay close to a 2.5% dividend yield. And the quality is very, very good. The management's very, very good. This thing is a very large cap, $239 billion. They made an acquisition recently of Rockstar energy drinks, if you're familiar. Of course, it's a small segment of their business, but this is one interesting thing to note about that. So this was just announced today, February 1st, Pepsi to launch hemp seed infused drink under Rockstar Energy. So you can see the picture here. You got different flavors, blueberry, passion fruit. So PepsiCo's latest drink from Rockstar Energy wants to help consumers chill out. Infused with hemp seed oil, spearmint, lemon balm, and only about 80 milligrams of caffeine, so a little bit less caffeine. Pepsi is hoping to attract younger female consumers to the drink. I just thought it was interesting. Pepsi is the pick, guys. They own Frito-Lay, so you think of Doritos. You can go check out their website. They own a lot of stuff. In fact, let's just go look. I'll show you really quick what Pepsi all owns. So this is on their website. You got everything from, Mountain Dew, Pepsi, Lay's, Doritos, Quaker oatmeal, Gatorade. You've got the Starbucks Frappuccino brand. They've got an agreement with Starbucks. You got Ruffles, you got Cheetos, Fritos, like all this stuff that's really not that good for you, a lot of it, right? But they have been breaking out into healthier brands as well. It's a big company, so they make acquisitions all the time. So you've got all these different things, like you got the hummus, line of brands. You've got this Bear, the Stacy's. There's a lot of stuff I don't really even know, but you notice a lot of these brands: Funyuns, Captain Crunch, Munchies. This is a consumer staple stock. It's expensive, but it pays you a nice dividend yield. The share price in a recessionary period, if that happened, I don't think that's going to happen, but if it did, this is one of those stocks you don't. And I've always liked Pepsi. I really do like it. It's just one of those, it's hard for younger investors to really put their money into it because they want to chase that hyper growth. But if you're looking for a little bit of a balance, check out Pepsi, PEP. Okay, the last one, guys, is going to be a SaaS play. Now, I really like SaaS companies, software as a service. There are a lot of stocks that I'd be buying at levels that we're at now, even though a lot of people could still say they're very expensive. I'm going to include Monday.com just because I think it was a unique opportunity. It got down actually below $200 on this recent sell-off. And in my opinion, I think this is probably worth more than $9 billion market cap. Now, this is not the environment for it. So if you're not familiar with SaaS, if you're not familiar with what these guys do, this might be more of a speculative type stock in your portfolio. But I like this one, especially if you can get it below $200 as a long-term investment. This is a newer IPO. I think it's misunderstood. It does carry risk, so it could easily go lower, guys. I'm not saying that the bottom's $200 or anything like that. You're going to need to see several different earnings. But when you look at like Oppenheimer just raised the target or lowered the target, but it was 460. They lowered it to 345. It's trading at $210. I'm not saying these price targets are everything. Piper Sandler, though, $380 price target versus 455. This stock is worth at least $300 in my opinion in a year. That's just my opinion. Who knows what happens, though, if the market does get a lot worse. This is not going to be a stock that does very well in that environment. So tread very lightly. But money.com, MNDY, check it out. So this is our Discord community, guys. Here you can see all the different channels. I encourage you to check it out. You can go on Patreon, Fired Up Wealth. It is a new month, so Patreon charges on the first of each month. So to maximize your time, definitely join now early in the month. You get the best bang for your buck. But this is, you can see Eric's portfolio in the top. You got Elite Chat, Elite Due Diligence. We do due diligence and share that with the team. So we've got separate channels for Nvidia, Tesla, Snowflake, Unity, UiPath, and so on. And there's a lot of great information on here. There's a whole stock pick spreadsheet down here, the 2020 top stock picks. All of them are down significantly from the beginning of the year. It's a great time to join the community. Check it out. Give us a try. Go on Patreon, Fired Up Wealth. If this video is helpful, guys, definitely subscribe. If you're new to the channel, subscribe. Click the like button on the video. Drop me a comment. I appreciate your time and attention. Appreciate your support. Hope you have a great rest of your day. Take care.